Gautam Trivedi joins us, managing partner with Nepean Capital. Gautam, good morning. Thank you for joining
Morning.
us. Your body language and smile tells me that you've been having a lot of fun in the market. Gains have been strong, right?
Well, gains have been strong in select, very, very select stocks, but I'm also smiling because I just got back from the US, where I attended my first ever time to Omaha to listen to Warren Buffett, and little did I know it would be the last, at least as a CEO. I hope he shows up next year, but the speculation if he does or not. But yeah, I'm just back from that.
That got over 1 month ago. So after that Omaha retreat 3 weeks ago, what did you do?
Well, I did a lot. I spent time in New York. I met a whole bunch of fund managers, asset allocators, went to Yellowstone National Park, which I highly recommend to anyone who's considering, visiting one of the national parks. And there's a lot, there's out there that I want to talk about as well, if I may.
What did we start with?
Yeah. So I think, a couple of things. The US economy clearly is robust and is absolutely thriving. I mean, whether it's hotels or whether it's restaurants, eating out, everything is not only expensive but full. So, and I'm not referring to just the city of New York, because that's clearly doesn't truly represent what's happening in the rest of America. But the fact is that if you look at inflation in general, it's raging. I mean, a simple celery and cucumber juice, for example, cost me $15. There was a time several years ago, maybe 8, 9 years ago, when I could have a full breakfast in $15, but that's just one juice, and that's how expensive things have become. But I think if you look at the overall economy, travel, just like in our country, even in the US, travel is booming. The Memorial Day weekend that just ended, AAA estimated that 45 million Americans drove or traveled 50 miles or more from their respective homes, which itself is a new record. And that's the way they measure travel. So every hotel that I took with my family in the 3 weeks that we were there, we took 8 flights. Every seat was sold out. So I think the ability of the Fed actually to cut interest rates in the US, again, what does all this mean with respect to finance and economics? I think the ability of Chairman Powell to cut rates, I think, is quite limited at this point until inflation really doesn't cool down. And I'm talking of inflation relative to pre-COVID. I'm not talking year on year, because that may optically look a little less, but that's not the right way to look at it.
Okay. Translate that for us in India, because while global inflation indirectly is bad news for us, but that also means that more flows will come back into emerging markets. That means dollar will remain weak. That means the search for yield will start again, and that's where a market like India would benefit. Am I summarizing it correctly?
No, you're right, but there are two. You're mostly right, but there's one other way to look at this as well. If you look at the domestic economy, which I just explained, that's obviously strong. But if you look at corporate earnings, and that's really what shocked me, I think it shocked me, and as I'm sure will surprise most of us, is that while we sitting in India pride ourselves of having 13 to 14% earnings growth, that's always the estimates at the start of a new fiscal year, and obviously for the last few years we've seen them prune down. But the first quarter earnings for the S&P 500 were as strong as 12%. Now you may ask me that, hang on, the Max 7 accounts for a bulk of it. Yes, the Max 7's earnings growth was 28%, but the balance 493 companies reported an average growth of 9%. So that's still very strong for an economy that's as large as the United States. So do keep that factor in mind. The other interesting report that I read from a sell-side firm recently, a US sell-side firm, that said that 50% of the large cap mutual funds in the United States that have a combined AUM of $3.5 trillion, their performance has outperformed, 50% of them have outperformed the benchmark year to date, versus the long-term average of around 37% of the funds outperforming. So things are pretty good back in the States, both from an economy standpoint as well as performance from the domestic equity markets. So as you said rightly, Nikunj, that the one thing that will force money to leave the United States will, of course, be weakness of the dollar. At this point of time, foreigners own 18% of US equities, and that's a record high as well. So any significant weakness or a prolonged weakness in the US dollar will clearly have money flowing out of the United States into Europe and, of course, emerging markets.
All right. Hi, Gautam. Good morning. This is Shrishti. But the last time you connected with us, for FIIs to be back in India, you believe that it will take time for the FIIs to return, but that was back in January. But now, Gautam, we are seeing that the FIIs are once again getting into the Indian markets, though in a staggered manner. There has been a bit of a buying in the cash segment, but are they here to stay? And in which sectors do you believe the investment can trickle in?
I think they're here to stay for the longer term, no question. I mean, let's get real. Of the $5.2 trillion of India's total market cap, foreigners own almost $1 trillion. So that's a huge amount in itself in absolute numbers. So they're pretty much here to stay from that standpoint. The question really is timing of returning back with a lot of money. And the feedback that I got for the most part was that India has gone from very expensive to expensive. Will it go to moderately expensive? I don't see that happening until domestic flows don't slow down. So if you look at year to date as well, foreigners have been net sellers of about 10 to $10.5 billion, but domestic mutual funds and insurance companies have plowed in about $32 billion. So that's the velocity of the money that's coming in to the equity markets from domestic flows. And as a result, until that doesn't slow down, I don't see the Indian market really getting cheaper, unless of course you see a significant improvement in earnings growth, which we haven't seen as yet. So the market remains elevated from from a valuation perspective. And the one feedback that I got that is interesting is that when I asked everybody about where would you put your incremental money, India or China, they said if the relationship between China and the US were to improve, incrementally, China looks definitely more attractive than India does because it's trading at half the valuation and also has pretty strong earnings growth.
Okay. But let's come back to India. I mean, India-China relationships, we don't know. So what we don't know, I don't know, we'll call it conjecture. But what we know is that there are a lot of themes in India. And I'm just looking at exchanges and financial themes, minus X banks, which is mutual funds, your stockholding companies, brokerages. Where are you picking a spot in this entire financial inclusion theme now?
So I think the NBFCs, for example, have had a tough run. We have invested recently in a gold loan company only because a large private equity fund is taking a solid position and pretty much where the promoter is stepping back. So we are, as you know, a special sits fund, and we look for that special situation in a company which makes it attractive for us and a potential for re-rating. So that's what we've done within the financial space. Financials, having said that, is our largest bet from a sectoral allocation. 31% of our AUMs are in financials.
No, I'm talking about, let's say, exchanges, BSE, NSE.
Yeah.
I'm talking about mutual fund companies. There is Nippon, there is there's HDFC AMC, there is UTI. That is the other theme. Then there are fee-based companies, wealth creation, wealth management companies, Nuvama, 360. And then the last but not the least, I think, are some of the brokerages, Angel, Motilal Oswal.
Yeah.
Are you picking up anything which is in the non-NBFC or the lending basket? I mean, lending we know could be banks or NBFCs. What about the other pockets?
No, we haven't actually. And we find even their valuations aren't cheap. So we've basically stayed away at this point from venturing into any of these non-BFSI spaces, but within the overall umbrella of financials.
Any interesting sunrise theme which you would say right now is at a niche stage but has potential to become big? For example, 3 years ago, solar was a niche theme.
Yeah.
Defense 5 years ago was a very niche theme. EVs 5 years ago, again, they were known but relatively unknown in terms of market presence.
Yeah.
Today, they become the mainstay for a lot of companies. Anything which is small could become big, or anything that is young could become tall and strong?
I'd love to say AI, but, people even ask me, would Indian AI, what's the best way to play it? Is it through Indian IT companies? Frankly, we haven't seen evidence of that as yet, of Indian IT companies developing expertise to a great extent in AI as yet. And I'm sure there's something that's happening behind the scenes. We don't know yet, but I think that could be potentially a story. Having said that, our sunrise sector, and again, it's not new really, but the one sector that's our second biggest sectoral allocation is power, which we believe is a multi-decadal story. So we are very, very strong on power. And the one thing that you forgot to mention, I think, is that was also, almost history, but has had a huge turnaround is wind energy. So we've seen, we've seen a lot of focus on that as well.
But Gautam, like you highlighted that from India being very expensive, it is moderately expensive now, and all thanks to the domestic fund flow. But Gautam, there are some concerns on the valuations of a couple of sectors that have been trading at higher valuation. Case in point being EMS. That was, I believe, also one of the stories that you have been liking. But do you believe that the valuations of these companies will be at these levels? There's not much headroom for the valuations to come back to moderate levels, and investors should be really prepared for that.
So let's talk about Dixon. We don't own the stock, but I just want to talk about it. So, it's really the poster child of the EMS business. And we've seen a lot of copycats come in and, people thinking they can match Dixon's execution, scale, and the ability to actually, get some of the biggest customers that are out there. But the fact is that the market continues to reward a stock like Dixon, which is trading at north of 80 times 1 year forward earnings. And the fact is, it's every quarter delivering 90 to 100% top line growth. Now, at what point will the market say, hang on a second, this is way too expensive? The day or the quarter when we see the earnings growth actually falter, the market is quite unforgiving. And if you've seen, especially in the last 12 months or so, even a slight disappointment ends up, seeing stocks getting punished a bit more ruthlessly than they really deserve. So my view is that the EMS space is here to stay. I think, can India become the services factory of the world? Clearly, I think it can happen. Companies like Dixon have clearly shown that, this is where Honhai was, 20 years ago, and look how big that company's become. They've grown from just assembling phones to actually starting to make the phones. So I think if you look at the evolution of where a Dixon or an Amber or any of these EMS companies could be 5 or 10 years from now, it could be very, very different. So the market's, I think, to some extent betting on that, and second, of course, rewarding the growth. So I don't see valuations, unfortunately, for EMS companies coming down. Question is, are you as an investor comfortable at a 75 or 80 times 1 year forward PE? And if you are, I think you'll make money in these stocks.
Have you? And I can fully understand that the celery and cucumber juice for $15, but you come to my office, I can offer a lot of garam chai. I can offer a lot of sugarcane juice, and it's not going to be for $15.
That's good to know. Our next encounter will be in your studio for sure.
Yes, look forward to that. Look forward to that.
If you like this video, then like, share and subscribe to ET Now.